Taxes on commodities and services are levied on transaction value of goods and services. As per the state list of the Constitution, the important taxes assigned to the states include sales tax, state excise duty, motor vehicles tax, passengers and goods tax, electricity duty, and entertainment tax. All these taxes contribute approximately 85% of the state's own tax revenue. Sales tax has its evolution in India dating back to the Kautilya's Arthashastra. In the present century, the Indian states were empowered to impose sales tax through the Government of India Act 1935. The first state to resort to a general sales tax was Tamil Nadu, introducing a multi-point sales tax in 1939. Following Tamil Nadu, many states resorted to this form of taxation. The Indian Constitution provided the authority to states via entry 54 of the state list to levy the tax on the sale or purchase of goods other than newspapers, subject to the provisions of entry 92A of list 1. However, the authority to levy tax on interstate transactions was given to the central government by entry 92A of the union list. Drawing the powers from the union list, Parliament enacted the Central Sales Tax Act 1956 to enable central government to levy tax on the sale or purchase of goods other than newspapers in the interstate trade. Thus, the sales tax has two components: state sales tax and central sales tax. The state government levy and collect sales tax on intra-state transactions, whereas the central government levies central tax on goods sold in interstate trade, but the tax is collected and retained by the states. The sales tax has been in vogue in Indian states for over 60 years now. Most of the states have levied sales tax at first point, that is, tax is levied on first transaction, for example, manufacturer to wholesaler. Efforts have been made in recent years to replace this by a value added tax, normally known as VAT, as the sales tax system had some inherent weaknesses. The first and the foremost deficiency relates to its cascading effect as it is levied at first point. Second, the existing system results in uncontrolled incidence of the tax. The total effective incidence on a commodity at the end of the chain of production distribution process was enormous. Also, it had a problem of multiplicity of rates. Multiple rates make tax structure very complex and increases administrative and compliance costs. Heterogeneity also prevailed in the structure of tax by having entry tax, luxury tax, etc. Fourth, economic consequences of widespread taxation of input leads to vertical integration of firms to avoid tax. Lastly, sales tax system lacks neutrality. It interferes with the producer's choice of inputs and outputs and thus creates economic distortion. The tax was levied in erstwhile province of Madras, which included the present state of Tamil Nadu and parts of many of the present southern states. The cost in collection of tax by the department is known as administrative cost, and the compliance cost refers to the cost borne by the taxpayer.
After learning this module, you would be able to understand sales tax and state VAT and how these two are different from each other. You would comprehend weaknesses of the existing sales tax system and learn how state VAT has attempted to overcome them. You would be able to evaluate how VAT is superior to first point sales tax and know why CST needs to be abolished for successful working of GST. Let us now understand the taxes assigned to states. According to the state list of the Constitution, the taxes that are assigned to the states include sales tax, state excise duty, motor vehicles tax, entertainment tax, passenger and goods tax, and electricity tax. Sales tax alone contributes to about 72% of the tax revenue from commodities and services, while the rest comes from states' excise duty, motor vehicles tax, and passengers and goods tax. Commodity and service taxes contribute approximately 85% of the state's own tax revenue. The Indian states are empowered to impose sales tax. Sales tax has two components: state sales tax and central sales tax. The Indian Constitution authorizes the states to levy tax on the sale or purchase of goods other than newspapers within the state. Central government is authorized to levy tax on the sale or purchase of goods other than newspapers on the interstate trade under entry 92A. However, the tax, CST, is collected and retained by the states. State sales tax is levied and collected on intra-state transaction by the state government. Due to some inherent weaknesses in sales tax, that is, cascading effect, uncontrolled incidence of the tax, multiplicity of rates, and lack of neutrality, it was resolved at the conference that all the states and union territories should implement uniform floor rates with effect from 1st of January 2000 and VAT from 1st of April 2001. However, some problems were faced in the implementation of the above recommendations. For example, there were states that did not have sales tax, namely Arunachal Pradesh and Mizoram. The second problem was related to the states or union territories which have not complied with the decision to have uniform floor rates. Thus, it was felt that prior to the introduction of VAT, states should rationalize their existing sales tax system by adopting two major reforms. The first reform related to the adoption of a four-state structure, that is 0, 4, 8, and 12.5% in the existing sales tax. These rates were in addition to two special rates of 1% and 20% for a few specified items. The recommended rates were floor rates. The states had the freedom to adopt a higher rate on any of the commodities from the list. The second reform pertained to the abolition of incentives related to sales tax, as all the states granted various incentives to new industries in the form of exemption from tax on the purchase of inputs or sale of finished goods, as well as tax loans and or tax deferrals.
To overcome the limitations of sales tax and to reform the commodity tax system, the Government of India took the initiative to design an acceptable structure for VAT. This was accompanied by a study report titled Reforms of Domestic Trade Taxes in India in 1994. The Government of India sought comments on the study report from all the states, and subsequently a conference of the Chief Ministers and Finance Ministers of the states was convened on 24th May 1994 to discuss the report. The conference took the view that as value-added tax being a new tax, a small committee of finance ministers should first review the report. Hence, a committee of 8 finance ministers of states was constituted. This committee gave its report in August 1995. The committee made some crucial recommendations. The report was discussed in the Conference of Finance Ministers held on 4th of July 1997. The conference recommended that all the states should shift to value-added tax or VAT at the same time after being given sufficient preparation time for implementation of this tax, and it also suggested that a model VAT legislation should be prepared for the guidance of the states. Accordingly, a model value-added tax or MODVAT law was prepared in 1998 and circulated among the states.
VAT is a multi-point sales tax which set off collected at each stage of the production and distribution process. It provides tax credit for all taxes paid on inputs, including capital goods. It does not have cascading effect. State VAT is the outcome of efforts made by many committees. Reform of domestic trade taxes in India in 1994. Committee of State Finance Ministers on Sales Tax Reform 1995 and Committee of State Finance Ministers for charting a time path for the introduction of VAT 1998. Haryana was the first state to introduce VAT on April 1, 2003. Most of the states implemented this tax in 2005, whereas Uttar Pradesh is the last state that introduced VAT on 1st of January 2008. Let us understand the implementation and collection procedure of VAT on a commodity with the help of an example. Suppose the commodity is taxable at the rate of 12%. Let us assume A to be a raw material producer and B to be a manufacturer, C to be a wholesaler and D to be a retailer. A sells his produce to the manufacturer at Rs 100 and pays tax at the rate of 12%. The sale price of Rs 100 would be the purchase price for B. After following the production process, he sells the final output to C at Rs 200. On this sale price, the gross VAT would be 12% of 200, which is equal to Rs 24. As A had paid tax on Rs 100, that is Rs 12, B would get credit for this. His net tax liability would be 24 minus 12, that is 12 rupees. That is, B would pay the government only Rs 12. Similarly, the sale price for C is Rs 300 and the gross VAT is Rs 36, that is 12% on 300. The net VAT liability would be 36 minus 24, which equals Rs 12. Lastly, D sells at Rs 400 and the gross VAT is Rs 48. The net tax paid by D to government is Rs 12. This procedure indicates that VAT is a tax on each stage of the production and distribution process. The total net VAT generated in the whole process is summation of net VAT generated at each stage, and it is Rs 48. Thus, it is a broad-based tax covering the value added by each commodity and service in a firm during all stages of production and distribution.
Under sales tax regime, all the states have given huge concessions to attract new industries. To review all such incentives, a small committee of chief ministers was set up under the chairmanship of Shri Jyoti Basu, the then Chief Minister of West Bengal, which submitted its report in 1999. The recommendations of the Committee of Chief Ministers and Finance Ministers were as follows. The number of rates prevailing under sales tax be reduced to a 4-rate structure. The number of exemptions under sales tax be curtailed considerably. No new tax exemptions known as incentives be given to the industries and the existing incentives be converted into deferment, and the value added tax should replace the existing sales tax system. It was resolved at the conference that all the states and the union territories should implement uniform floor rates with effect from 1st January 2000 and the value added tax from 1st April 2001. Also, it was decided that the interim period would be used for preparation, training, computerization and publicity. However, some problems are faced in the implementation of the above recommendations. First, there were states that did not have sales tax, for example, Arunachal Pradesh and Mizoram. It was recommended that these two states must introduce value added tax by enacting a suitable legislation so as to fall in line with the rest of the country. The second problem was related to the states, union territories which have not complied with the decisions to have a uniform floor rates. The standing committee recommended that the states and union territories, if not introducing value added tax, 25% of their financial assistance that was provided to them by the Government of India be withheld with immediate effect. Also, it was suggested that a team of empowered committee visits these states and union territories to convince them to implement the same. Thus, it was felt that prior to the introduction of value added tax, states should rationalize their existing sales tax system by adopting two major reforms. The first reform related to the adoption of a four rate structure, that is 0%, 4%, 8% and 12.5% in the existing sales tax. These rates were in addition to the two special rates of 1% and 20% for a few specified items. The recommended rates were floor rates. The states had the freedom to adopt a higher rate on any of the commodities from the list. The floor rates have checked the rate war and diversion of trade among the states. However, when the states started implementing the four rate categories, many of them found it difficult to impose it on some commodities. Either there were problems with the classification of goods or there were administrative difficulties in implementing the floor rates. The second reform pertained to the abolition of incentives related to sales tax, as all the states granted various incentives to new industries in the form of exemption from tax on the purchase of inputs, sales of finished goods, as well as sales tax loans and or tax deferrals. Various studies and committees reports have already argued against such incentives and pointed out that these incentives take the form of tax competition or war and lead to harmful tax practices in a federation. As suggested by the committee in 1999, all the subnational governments have stopped giving sales tax related incentives to new industrial units. However, there still existed the concessions already granted to the existing units. After the introduction of the VAT, these incentives have been converted into a system of tax deferral or remission.
All the states have a system of VAT. The coverage of tax includes sale of all goods except diesel oil, petrol, aviation turbine fuel, natural gas and liquor. VAT has a standard rate of 13.5% on all goods except those listed under 0%, 1% and 5% categories. The first category consists of goods which are taxed at zero rate, that is, exempted from levy of tax. These goods comprises natural, unprocessed products and goods which have social implications. While the list is common for all the states, Each state is allowed to add a maximum of 10 goods of local social importance to the list of exempt items, provided goods do not have any interstate implication. Example, kumkum or bell metal in Maharashtra or gamocha in Assam. The second category comprises items that are taxable at the rate of 1%. These include gold, silver, ornaments made of gold and silver, precious stones, including semi-precious stones, and real, artificial, or cultured pearls. The 5% rate category includes goods of basic necessities, namely food items, agricultural products, medicines and drugs, and declared goods. Also, it includes chemicals, inputs, and capital goods. It covers more than 270 items. The goods taxable at the rate of 20% or more are motor spirit, that is petrol, diesel, and aviation turbine fuel, liquor, etc. The commodities listed in this schedule are under first point sales tax and not covered under VAT. Though there is general uniformity among all the states, variations do exist among some of the states. Most states provided some attractive incentives to lure industries. These incentives were in the form of tax exemption, tax waiver, tax deferral, tax loan, and refund of sales tax for select industrial units for varying periods depending upon the location of industry in backward or developed areas of the state. These incentives were offered to new industrial units set up after a notified date for the purpose of regional development. These had adverse effects on the state's revenue and led to beggar thy neighbor policy. In value-added tax regime, such incentives create problems in tax credit. It was therefore resolved by the Empowered Committee, as recommended by the first report of the Finance Ministers on introduction of VAT, that no new incentives would be granted under sales tax. As a result, all the industrial incentives were discontinued with the introduction of VAT, and also all other taxes such as turnover tax, surcharge, additional surcharge, and special additional tax were abolished. While there exists a general uniformity among all the states, variations do exist among some of the states. Efforts are being made by the Empowered Committee of State Finance Ministers to ensure that there is complete uniformity in the rates. In Punjab, Tamil Nadu, Gujarat, Bihar, and Madhya Pradesh, there is a specific provision for levying purchase tax on some commodities. This tax is leviable on goods, first, taxable under VAT but purchased from unregistered dealers. Second, goods bought by the registered dealer from the dealer which does not pay any taxes on the sale price of such goods and sent on consignment. Third, used in the production or packing of tax-free goods. Or fourth, consumed in the manufacture of other goods for sale.
Many states have provided some attractive incentives under sales tax to lure industries. These incentives had taken various forms and applied to different industrial units for varying periods depending upon the location of industry in backward or developed areas of the state. The concessions may be in the form of tax exemption, tax waiver, tax deferral, tax loan, and refund of sales tax. These incentives were offered generally to all new industrial units if units were established in certain identified backward regions. The quantum and scope of the incentives differed according to the area in which the industries were set up. Sometimes the incentives were offered on a selective basis. In many states, the exemptions were offered with the objective of regional development. In value-added tax regime, such incentives create problems in tax credit. Therefore, all the industrial incentives were discontinued with the introduction of the VAT, and also all other states or other taxes such as the turnover tax, surcharge, additional surcharge, and special additional tax were abolished.
Interstate trade is taxed under Central Sales Tax or CST. This was introduced to regulate interstate trade and to ensure an equal tax treatment for goods entering into interstate trade with locally produced goods. This is levied at the low rate of 2% on interstate sales to registered dealers and higher rate of 10% on sales to unregistered dealers. The rates are low for the registered dealers as they pay state VAT on their sales, while the unregistered dealers do not pay any taxes on their sale. CST cascades and results in higher prices in importing state. The producing states use this measure to export their tax to the consumers of other states. With the introduction of GST, the union and states have agreed to phase out CST. This table shows that the state VAT is an important tax in states' fiscal armory. The figures within parentheses indicate as a percent of states' own tax revenue. This constitutes a major source of revenue for the state governments. Its yield has shown an upsurge with a growth rate of 14.24% and buoyancy of 1.03 over the period. VAT as a percentage of states' own tax revenue revolved around 61% in most of the years. Its share was 62.2% in 2000-2001 and 62% in 2012 to 2013. The trend in sales tax can also be understood graphically. Its yield has shown an upsurge from Rs 21,064 crore in 1991 to 1992 to Rs 76,885 crore in the period 2001 to 2002 and to Rs 4,10,506 crores in the period 2012 to 2013, with a growth rate of 14.24% and buoyancy of 1.03 over the period. Sales tax revenue collected by all the states as a percentage of states' own tax revenue revolved around 61% in most of the years. Its share was 62.2% in 2000-2001 and 62% in 2012 to 2013.
Let us now recapitulate what we have studied in this module. Taxes on commodities and services are levied on transaction value of goods and services. Commodity taxes assigned exclusively to the state governments are sales tax, now called state value-added tax, state excise duty, motor vehicles tax, passenger and goods tax, and electricity duty and entertainment tax. Among the taxes, sales tax contributes nearly 61% of the tax revenue to the state exchequer. All these taxes taken together contribute approximately 85% of the state's own tax revenue. Sales tax has two components, that is the state sales tax and central sales tax. State sales tax is levied and collected by the state government and levied on the taxable turnover. The central government levies central sales tax on goods sold in interstate trade. The tax is collected and retained by the states. With the introduction of value-added tax, the union and the states have agreed to phase out CST. Sales tax has been replaced by a system of value-added tax known as the state VAT. It took almost 10 years from 1995 to 2005 to implement state VAT in all the states. VAT is a multi-point sales tax with set-off collected at each stage of production and distribution process. It provides tax credit for all taxes paid on inputs, including capital goods, and therefore does not have any cascading effect. Value-added tax has 4 rates: a standard rate of 13.5% and 5% rate on necessities. Besides, it has 0 rate and 1% rate. Petroleum and petroleum products and tobacco have maximum rate of 20% and it is not under value added tax system.